That concept, the $3,000 that you're going to lose if you buy a premium bond, or the $9,000 that you're going to gain if you bought the discount bond, gives rise to the concept of amortization and accretion. And those of you that have studied your annual OCI report have probably noticed some entries on that report regarding amortization and accretion. Maybe you completely understand it, but if you don't, here's a little explanation of what that involves. If you paid a $3,000 premium to buy that bond, and you're going to lose that $3,000 when it matures, the question is, when do you book that loss? And the answer is, you're required for both accounting and tax purposes to amortize that loss each year over the remaining life of the bond. So, in other words, you're going to lose $3,000. That's over a 3-year period, so it's going to come due in 2016. So, one way to do it would be you're going to book no loss in year 1, no loss in year 2, and then you book a $3,000 loss in year 3 when the bond actually matures. But what amortization requires is not that. It says you're going to book a $1,000 loss in year 1, a $1,000 loss in year 2, and then a $1,000 loss in year 3. So it amortizes out that loss, so you don't have it hit all at once, both for accounting purposes and for tax purposes. Accretion is the other side of the coin. So now we bought a bond at a $9,000 discount. We paid $91,000 for a $100,000 bond. When do you recognize that gain? Well, if we didn't do an accretion, the gain would look like this. There would be zero gain in the first year, zero gain in the second year, and then $9,000 a gain in the third year. But again, that's not what they want you to do for accounting purposes or for tax purposes. So what happens here in this situation is you would recognize a $3,000 gain on that investment in year 1, a $3,000 gain in that investment in year 2, and then a $3,000 gain in year 3 to again level out the accretion in that value of that bond. So all of this gives rise to the concept of yield to maturity. The prices, premiums, or discounts, and so forth gets us to the value of the bond, and now we have to use that value to calculate something that we call yield to maturity. This is not only the best, but it's really the only proper way for determining the fairness of the price of the bond that you're buying. It's a mathematical equation.